Okay, let's talk about the annual planning that needs to be done. So your advisor and their supporting team is working hard for you. So during your annual review, we want to go through several topics and make sure that we cover them. One is cash flow, meaning any money coming and going from your overall life, your bank accounts, just what you're living on, your projections of that, the safety of your long-term cash flow, all of that. That's cash flow. Then we also want to cover investment strategy. How do you feel about the risk, the portfolio, the progress? How are we doing at reaching your overall goals? And then third, tax strategy. So this is tax analysis and any action that we can do to reduce your liability. So it's really important that you share any changes to your income, expenses, major life events you may be having, or really just any preferences that you have or feelings that you have where money and your life comes together. We can help you with all of that. We're going to talk about a couple common mistakes, and then you've made it. So the common mistakes that we see are folks jumping the gun a little bit too early. The documents might not be ready, you file your tax return, then you get another document and have to amend the tax return. We've already talked about that a little bit. Second mistake is forgetting to account for non-retirement accounts. Dividends, interest, capital gains. You might not have taken any money out of your accounts, but if it is a normal brokerage portfolio, not a retirement account like an IRA or a 401k, if it's just a normal brokerage portfolio, you will get a 1099 for that account. And even though you didn't take money out, you need to include that income on your tax return so that your accountant can account for it and you make sure you cover any tax liability associated with it. We've talked about deductions so far, but the third mistake is folks misunderstanding the itemized versus the standard deductions. For example, sometimes people will make a contribution to a charity and think they're going to get a tax deduction for doing that when they were taking the standard deduction anyway, and the contribution will not allow them to itemize because it's just not enough. So it's important to understand where you stand within standard and itemized deductions so that you don't take a financial action expecting a benefit and then not having that come to you. One of the most painful and mathematically most devastating is forgetting to tell your tax preparer that an IRA withdrawal was actually a qualified charitable distribution. We talked about how beneficial that is. However, many tax preparers don't have a great way to know that it was a qualified charitable distribution. So it's really important that you tell them. Some custodians are putting a little tag on it that's helpful for you to see, but it's really on you and us to help you know that this is something to let your accountant know that a qualified charitable distribution happened and you don't need to include it as part of your taxable income. Along the same lines with charitable contributions, don't forget to tell your accountant about any money and other things you may have donated to charities. Okay, the next one is more of a long-term mistake that we see, which is an individual may be in a really low tax bracket and then forget to take advantage of what we call headroom within that bracket. Imagine you are in the 0% capital gains bracket. You could be taking capital gains inside the portfolio with no tax cost. Or imagine you are at a 10 or 12% bracket with regular income. We could potentially be doing Roth conversions in that space and moving money from a pre-tax status to a post-tax status at a pretty low rate. So it's really important to understand the brackets and where you land and where you think your tax brackets might be in the future. Okay, another mistake is not thinking about potential changes in tax rates with the end of 2025. This is really hard because with the current administration, we've talked about this, it's hard to predict what will happen with the Tax Cuts and Jobs Act and the rates associated with that. So we want to be thinking about that, but also not betting too much on one way or the other and what policymakers will do.